Hello, good afternoon. Sorry. Hello, good afternoon, everyone, and welcome to today's episode of Modesty's Property Corner. Today we are on season 1, episode number 17, and today we're going to be discussing contractor mortgages. Yeah. So today I'm going to be putting on my mortgages hat and not my estate agency hat. So this is Modesty Property Corner, and here we discuss, properties and mortgages and property related things. And as some of you may well know already, I am a mortgage advisor, a qualified mortgage advisor, and I am here as mortgage advisor working with an FCA regulated firm called the Independent Mortgage and Loan Company. So this is the company that is affiliated to us and that we work with on everything mortgage. They are FCA regulated, and every deal and everything we do is protected by the authorities. So just a caveat here, please, we do not offer mortgage advice here. All we do here is just offer information and education and enlightenment. That's what we're here to do. If you need professional mortgage advice, you can contact me later on, and we'll talk about your circumstances, and we'll give you advice on another day, a separate arrangement. But for the purpose of this broadcast, this is purely educational. And please remember that your home may be repossessed if you fail to keep up with the payments of your mortgage. So the essence of this is to educate us on how contractor mortgages work. Nothing said or done here is intended to be a regulated advice or a regulated practice. Okay, so that's housekeeping done, and that's housekeeping out of the way. So what are we actually talking about today as far as contractor mortgages are concerned? First of all, we need to understand who a contractor is. So that if you fall into that category, by now you should know, but for some people they may not even know that their mortgages could be done through a contractor mortgage. They might be thinking they're just, everything falls under normal employment contract or normal employment employee mortgage. So what contractor mortgages came out as a result of lenders being very creative and being acknowledging the fact that the way people work have changed over time, and people now earn their monies in different ways, in different formats. That there are people who are contracted for a specific period of time for a job or for a contract or for a project, and for that specific period of time a pay is arranged, maybe on a daily basis or on an hourly basis or on monthly basis or on annual basis, on whatever basis. That period is that project or that employment is fixed for that period, and it only lasts for the period of that contract. So people like that used to miss out on mortgages because their income were considered not regular enough. But then lenders, acknowledging this, knew that these people are actually earning money, and some people have been earning very good money on this, and they have been doing that over a period of time. So they were of the opinion, if we can establish some kind of track records, or if we can establish some kind of consistency in how these people earn or what they earn, we should be able to assess their earnings and offer them mortgage. So contractor mortgages became the solution. So contractor mortgages, anyone who is employed by an organization or through an agency for a particular period of time, who is bound by the contractual obligations guiding that particular period of time and that employment, is a contractor. So there are a few features of this sort of income that are very unique, and we need to explain here. First of all, you talk about how they are paid. Contractors, some of them are paid on daily basis, so some of them earn a daily rate. Yeah, so it could be 300, 250 pounds, 500 pounds, whatever it is on daily basis that they rate. That is their daily rate. And then their working hours or their working days are also fixed alongside their pay. So they might be expected to be working 5 days a week, earning £400 a day, for example. So that's their daily rate, and their working hours or days fixed and sorted. The way they are taxed, again, is one thing that stands contractors out as well. For some contractors, their taxes are deducted at source by the employers who contracted them directly, or by the agency that they are working for, or by the umbrella company that is managing their payments and their tax affairs. So sometimes these contractors and contractor mortgages could be more complicated than you might even understand, because there might be umbrella companies involved, and the umbrella company might not even be the main contract provider. The umbrella company might be working with an agency, and then the agency might be the one providing the contract, being tied to another employer. So in some cases there are three parties involved in the contract before it even gets to the main person who is the contractor. Okay, there might be the main employer, or called the client, an agency might be involved, an umbrella company might be involved, and each of these bodies or each of these organizations have a role they are playing in the whole contract situation. Sometimes it might be just a direct contract between the contractor and the organization, which is a lot easier to deal with, especially for administrative and for mortgage purposes. Okay, so the way they are contracted as well, which I have touched, is another unique thing. Some of them are contracted to an agency, some are contracted directly, by the employer. So let's look at the different types of contractors that we can come across. So there could be employed fixed-term contractors, and there could also be self-employed fixed-term contractors. And as the term sounds, you see, employed fixed-term contractors. So the way lenders categorize them, a lender can categorize you as an employed fixed-term contractor because that's the way they feel you're earning will enable them to assess your affordability for that mortgage. It doesn't necessarily mean that you are employed by that company or by that organization directly. It doesn't necessarily mean that you have a direct contract with the organization. You might have a contract with an agency, and that agency will be working with a client, and then you are working for that client, but you are employed by that agency. And then when you go to get a mortgage, the lender might decide to treat you as an employed fixed-term contractor, because that's the category you fit into in their criteria, and because of the way you are paid. So that's why I've just picked out these two categorizations of contractors, as an employed fixed-term contractor or a self-employed fixed-term contractor. So, and if as the term sounds as well, you can see it's mentioned fixed-term contract. So the term of that contract is fixed. So it could be 6 months, it could be 6 months, it could be 12 months, it could be 3 months, it could be 24 months, however long it is, but it is fixed. And then you are categorized as an employed fixed-term contractor. So this category also fits very well into people who directly are employed on a contractual basis by the employer. So they are also employed fixed-term contractors. And by that, you are not an employee of the company. The company is contracting you for a fixed period, after which they will review the contract. So they will either decide to renew the contract or decide to let you go when the contract is up. It might be tied to a particular project as well that you're carrying out. And once that project ends, the employer might think they might feel they don't have any need for you anymore, and they might ask you, to go because the project has ended. So it saves the employers, national insurance tax and PAYE tax. They don't have to provide you with any benefits or anything. So some employers, it works best for them just engaging you on a fixed-term contract basis and allowing you to deal with your taxes and everything. But IR 35 has come in and has disrupted a few things in terms of how contractors are taxed. So the government felt that some contractors are being treated some contractors who are actually employees are being treated as contractors. But in terms of everything else, that terms of the nature of the relationship between them and the employer, they are basically employees. But then the employer is using the contractual terms to avoid paying NI contributions and the taxes that they are supposed to pay on behalf of that employee. So the government has decided to bring in what they call the IR35, mandating employers to convert every fixed term contract that has a nature of employee relationship into full-time employment, so that they can rectify the relationship between them and the employee. And it has worked a little bit better for some employees as well, because some of the benefits that they are entitled to, like holiday pays, like annual leave and all that they've been denied for so long because of the contractual nature of their employment, they were now entitled to those. But here we're not here to discuss contracts. I'm just I'm just digressing a bit because I wanted to throw more light on the IR35 thing. So the IR35 has kind of disrupted things a little bit, that the way some contractors are taxed now. IR35 has mandated them to make sure that their taxes are deducted at source, especially those that have relationship with umbrella companies or even directly with some firms. IR35 doesn't allow them anymore to take all the money and then sort their taxes out later, because they have been absorbed, or they've been forced to be absorbed by the employers as employees, or they have to get their taxes deducted at source. So the government is always looking for a smarter way to increase their coffers. But self-employed fixed-term contractors, you can either be a sole trader or a limited company, so it's all about how you are being paid. If you're being paid as a self-employed person and you have a limited company, the contract will be between your limited company and the employer. If you're a sole trader, the contract will be between yourself and the employer, but you are registered with the HMRC as self-employed, which means you have to take care of your own taxes. So from the onset, you would have decided with the employer or whoever you have the contract with how you wish to present yourself, as employed or self-employed, limited company or sole trader. So most of the self-employed fixed-term contractors are allowed to sort their own taxes out, as long as they can show proof of registration either with the company's house or with the HMRC. Okay, so their taxes are not deducted at source. Then that brings us to the different types of contracts that exist. There are fixed-term contracts. Now, with fixed-term contracts, as the name sounds, the term of the contract is fixed, and the term here specifically refers to the duration of the contract. So if it's a 12-month contract or 6-month contract or 3-month contract, it's fixed. It means your earnings, what you have been contracted to earn within that contract, will remain the same. Nothing will change. The conditions of the contract will remain the same throughout the duration of that contract, and every single thing that has been agreed on that contract is fixed for that period of 3, 6, 12 months or however long the contract will last. Now, fixed-term contracts can either be long or short. There are short-term fixed-term contracts like 3 months contract, 6 months contract. It could be long, like 12 months or 24 months or even more, depending on how you have negotiated a contract with the employer. Then secondly, there are rolling contracts. Now, with rolling contracts, it could be 3 months, it could be 6 months, it could be 12 months. But the key thing here is that contract, once the first term of that contract runs out, it goes on a rolling basis. It could be rolling on a monthly basis, it could be rolling on a quarterly basis, it could be rolling on a 6-monthly basis. Which means if it's a 3-month rolling contract, once it gets to that 3 months, it just keeps going like that for another 3 months. It just keeps going like that for another 3 months. And the employer can decide to terminate the contract at any time, as long as they have given you enough notice. as guided by the contractual terms. It could also be rolling on a monthly basis, depending on how they agreed the rolling contract would be. So if it's rolling on a monthly basis, if the initial contract period is 6 months, they could decide that the next contractual arrangement will be on a rolling contract basis. It might be a project that they are working on, and that project, after 6 months, they would have considerably gone very far in that project, and they may not know when that project is specifically going to end. So if they need your services to complete that project, they might just put it on a rolling contract, because it doesn't tie the employer down to anything else. So if after a couple of months, after the 6 months, the project ends, after 2 months, they might just say, yeah, the project has ended, we want to terminate the contract. So the rolling contract is more flexible than the fixed term contract, because it could be terminated after one rolling period has elapsed. With the flexible contracts, now flexible contracts can also be regarded as open-ended contracts. There are contracts that are open-ended, where there are no fixed term in it. It's open-ended. It can be terminated anytime, as long as the notice period has been given by the employer and also by the contractor yourself. So those open-ended contracts is almost a rolling contract, but there is no fixed term. That's why it's a flexible, open-ended contract. You just have that contract. You as a contractor can walk away from that contract when you want, as long as you're given enough notice. The employer can decide to terminate the contract when they will. So there is this lack of security in that sort of open-ended contract, as some people might look at it. Also, the other people might look at it as being flexible. That's exactly what they want. So that if they want to walk away, they can walk away. But then it lacks that security. And for lenders, that sort of flexible contract is not something that a lot of lenders like, when it comes to mortgages, because then they cannot see a security. They don't know whether that contract is going to end tomorrow or is going to end, the next week. So for some lenders, if they come across a flexible contract, they will be looking at history. Your professional history, your contracting history, to see whether you've got solid track record in that line of profession, which means that if you lose this contract, it will not take you time to get another contract. So that's one thing that the lenders might be looking at when they come across flexible contracts. So how are contractors' income calculated? Now, contractors' income are worked out according to how they are paid, and it's a funny one that some people who are contractors, when it comes to mortgages, if you're on a daily rate, the way lenders will work out how much you earn a year, and upon which they will base your affordability assessment, is to multiply your daily rate by the number of days you work, and then multiply it by the number of weeks that the lenders have set. So it's not necessarily the number of weeks in the year. There are 52 weeks in the year. So most lenders don't use the whole 52 weeks in the year to multiply your daily rates to arrive at the annual income. The reason being that they normally want to give room for weekends and for breaks and for holidays or whatever. So some lenders use 46 weeks, some lenders use 48 weeks. But I have also come across lenders who use the full 52 weeks. Okay, so these are the most popular ones: 46, 48, 52 weeks. Some very cautious lenders might go as low as 42 weeks, but the most popular ones are 46, 48, and 52 weeks. So what they do is, if you are earning, say, £300 a day, what am I talking about? £300 a day, and then you are contracted to work 5 days a week. So if the lender is using a 48-week period to work out annual income, so your annual income upon which your mortgage will be calculated will be 300 times 5 times 48. Right? So 300 times 5, that's 1,500. 500. And if you multiply that by 48, so on that sort of income, your annual income will be 300 times 5 times 48 weeks. You'll be that will be 72,000 pounds a week. So the lender will assume that you're earning 72,000 pounds a year. 72,000 pounds a year. That's the annual income they will base that mortgage affordability assessment upon. But you know that on a normal, if you want to work out your full yearly earnings, it would have been 52 weeks, which would have been 300 times 5 times 52, and that's 78,000 pounds. So it's 6,000 pounds short of what it should have been if you were working out based on a full yearly, weekly earnings. But the lenders, want to take into consideration that you don't work weekends, you don't work every day, and you're going to take breaks or you're going to take holidays, just giving room for things that could happen during the year. So they'll base it on either 46 weeks or 48 weeks. If you're lucky enough to get a lender who is basing on 52 weeks, it means you can, they'll base it on more income, which means you can borrow more. If you are a contractor earning paid on an hourly basis, the way it is assessed is the lender will work out what your hourly rate is. If you're on £10 an hour, for example, let me just use £20. If you're £20 an hour as a contractor and you work, say, 7 hours a day, that's 20 times 7, that's £140 a day. So multiply that by the weekly earnings, which is 5 days a week. If you work 5 days a week, that's £700 a week, and then multiply it again by either 46, 48 or 52 weeks. So that's how hourly rates are worked out. The hourly rates multiplied by the number of hours you're working, multiplied by the number of days that you're working in the week, and then multiplied by the number of weeks that the lender has set as their criteria. If you're being paid on a fixed monthly rate or a fixed annual rate, most lenders will take that on face value. So if your contractual earnings says £38,000 per annum, the lenders will use £38,000 to work out your income, your annual income. If you're being paid, if you're fixed for £2,500 per month, the lenders will want to see your pay slip to see if the taxes are being deducted at source, or you are taking the whole money and you are paying the taxes yourself. Whatever it is, they will decide to use the annual income, the gross pay anyway, to work out what your annual income is, and upon that base the lending decisions. Okay, so what are the things that lenders do consider when they are looking at contractor mortgages? The things that lenders consider is, first of all, they look at experience, right? If you're a contractor, maybe you're an IT contractor, the lender will look at your experience. How experienced are you in the line of IT? Have you been working in that line of IT for, say, a number of years, or 1 year or 2 years? Have you been contracting as an IT contractor? Experience in contracting and experience in that line of profession are two things that lenders will consider. So if you, for example, are on a contract with an agency, the lender will want to see experience either in an employed capacity or in a contracting capacity for at least maybe 2 years. Because you're employed by an agency, the contract through an agency, the lender will be looking at experience, either contracting experience or experience in that line of profession in an employment capacity. The second thing that the lenders are looking at is longevity. The contract you are currently on, how long is that contract going to last for? And after that contract, what happens next? How many times has that contract been renewed? If that contract has been renewed once, then it means that if you're your second renewal, the lender is more confident that if you have renewed once, you're your second renewal, there is a very good prospect of another renewal happening, or you can get another contract somewhere else because you've gained some renewal experience, or you've gained some experience on there. The other thing that the lender will be looking at as well is how long is left on the contract term. Some lenders want a minimum of 3 months on that contract left at the time you're making an application. In fact, recently I was working on a particular contractor mortgage. When I spoke to a lender and I said, okay, this person's contract is going to be finishing in the next 2 months, and the lender said, too bad, we need 3 months minimum left on the contract. And I said, but this is a 7-month contract and it's just 4 months gone, 5 months gone in the contract, and they're just 2 months. I said, too bad, we still need 3 months left minimum. That's the that's the criteria. And then there was another case where I now said, okay, this is a 3-monthly renewal contract. He has renewed the first month, he has finished the first 3 months, and it's been renewed again for another 3 months, but 1 month is already gone from that 3 months. What's going to happen? The lender said, unfortunately, we need 3 months left on the contract. So it means if we had approached the lender immediately the contract was renewed, it would have met the lender's criteria. But because the deal came 1 month after the contract was renewed, this particular person is unfortunate enough to have the lender say, no, we need at least 3 months left. So these are some of the tricky things that happens on contractor mortgages. But this is a contract that has been renewed already. The first 3 months is gone, it's on the second 3 months, but because those technicalities didn't fit in, the lender said no. But that doesn't mean that that's the end of the deal, because we can always go to another lender. There are various lenders with various criteria when it comes to things like some lenders will want minimum of 6 months left on the contract before they can even touch the contract. So different lenders with different criteria when it comes to things like this. The other thing that lenders will be looking at will be earnings. Some lenders mandate that anyone who wants a contractor mortgage must be earning at least £50,000 a year for them to consider that as a contractor mortgage. And that £50,000 a year must be on the lender's criteria, which means if they work it out based on 46 weeks, the £50,000 must fit within that 46 weeks. If they work based on 48 weeks, it must fit within that 48 weeks. So there is for some lenders, there's a minimum earnings threshold before they can consider that contractor mortgage. For other lenders, there's no minimum income threshold as long as it ticks other criteria boxes for contractor mortgages, they're happy to consider that. The other thing that lenders will consider is the employer status. Who is the employer? On what status? Are you directly contracted to the employer, or are you engaged through an agency or an umbrella company? It makes a difference for some lenders, because if you are engaged through an agency, the lenders will want to see, a lot of lenders will want to see minimum of 2 years contracting history if you're engaged through an agency, for them to be satisfied and convinced that you have enough track record and experience in that field as a contractor. If you are engaged directly with the company, it makes a lot of difference, because it makes lenders feel very much more comfortable dealing with that, especially if it's a long-term contract as well, maybe 12 months or more, or even 6 months contract directly with the employer. So for some lenders who are happy with the first-time contractors, if that's your first time of contracting, it's directly with the employer, some lenders are happy to do that as long as it's directly with the employer. If it's not directly with the employer, and if with an agency, but you have been employed in that role in another capacity, even with another organization, there will be, some lenders will consider that as well. The other thing they are considering is the contract time. Is it a fixed contract, a rolling contract, or is it a flexible contract, which we have discussed earlier before? A lot of lenders don't like flexible contracts that are open-ended, that doesn't have a fixed term. Most lenders prefer a contract that has a start date and an end date. If there is a start date and there is an end date, then they know what time frame they are working with and how to assess that. If there is no start and end date, then they will look at the full terms and conditions of that contract to see what that contract provides you and how secured that contract is. What matters to them is the longevity and the consistency in those earnings. The other thing that lenders look at is the annual income, how the annual income is calculated, 46, 48, 52 weeks, and however it is calculated. They will look at how they calculate your annual income and come to a conclusion as to what your annual income is. So once these boxes are ticked for lenders, Remember, all different lenders have different criteria, so all lenders are not the same. Once it fits lenders' criteria, they are happy to do that.